Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week's episode is number 95, and my friends, we have a new tax reform bill. The House Ways and Means Committee just in this last week drafted and published a tax reform bill, which is really the piece of legislation we've been waiting on for quite some time. It hasn't become law yet. As I explained in the episode, typically I don't like to pay too much attention to this stuff until it goes through the Senate and becomes a lot closer to becoming law. This is an exception to that for a couple of reasons. The bill itself is a bit of a whopper. There are a lot of relevant changes to you, perhaps, to a lot of our clients, certainly, that you probably should be aware of and may want to take action on before the end of the year, hence the timing of this podcast. So in this week's episode, I cover a lot of the substantive points you should probably be aware of that are in the bill that is somewhat likely to pass. You have to forgive me because the quality of the audio this week cuts in and out a little bit, but we spend time taking the relevant points from the tax bill that you should probably be aware of and, again, may want to take action on before the end of the year. I hope you enjoy it. Hey, everybody. Real quick before we jump into today's episode, I have been advised by my attorneys to remind you all that none of what you might hear in today or any other episode of Grow Money Business is financial, investing, tax, legal, fitness, or even relationship advice. It's content that you're free to use and deploy on your own terms. And before you take any actions on what we might cover in the show, I really encourage you to consult with your accountant, attorney, or financial planner. If you don't have a financial planner and think that you might need one, be sure to check out threeoakswealth.com to learn more about my firm's planning, advice, and investment services. So this week on the podcast, we're going to be talking about taxes. Oftentimes when we're talking about proposed tax legislation, or really any potential legislation that's going to affect our clients in the financial planning firm, their businesses, and by extension, me, really. Anytime there's proposed legislation, I don't pay that much attention to it, to be honest, until it becomes law. Because so many changes to bills are made throughout the legislative process that it's usually kind of a fruitless exercise and a waste of time, frankly, to spend too much time evaluating potential changes before they're actually signed into law and effective. That said, this time around, it's a little bit different because the potential changes coming down the pipe from a tax perspective are going to impact a lot of people listening to this podcast. And the stuff that you should do about it has some urgency with regard to time windows. There are some things you can do between now and the end of the year in this circumstance when when the current bill in its current form may get passed. So I'll talk specifics about all this, but the background here is that President Biden has communicated his tax agenda for some time. And if you've been a longtime listener of the podcast, you've heard me review what his tax agenda has been, what he's communicated, the stuff he wants to do. Of course, that's not all going to happen unilaterally. It has to go through the legislative process. Stuff gets added, stuff gets dropped. We don't know exactly what the law changes will ultimately be. Now, this last week, the 13th of September, I believe was the date, the House, I think it was the Ways and Means Committee, published their draft of the American Families Tax Reform Plan. And whereas there was always going to be a lot of this horse trading that goes on in the legislative process, adding some stuff to the tax code, changing some existing stuff, dropping others. Usually that stuff happens, there's a group in the committee that drafts the bill. It goes to the legislative floor, either in the House or the Senate. They debate it, discuss it. There's that horse trading that goes on. They get the bill after doing that kind of horse trading and negotiations to a form where they believe it will pass when voted on. They vote on it, and then it goes to the other house of Congress. If it's being negotiated in the House, it goes to the Senate, and vice versa. The other house either passes it or doesn't, and then it goes to the desk of the president to become law or vetoed. And you have the supermajority limitations there, to where if you get 2/3 supermajority, I can't remember if it's in one or both houses of Congress, then the president can't veto it. So the reason that we're talking about this now is a lot of the negotiation of this bill seems to have already happened by the way that it's been written. And there was a lot of stuff that's in Biden's tax reform agenda that's included in the bill. There's also a lot of stuff that he didn't mention at all, which tells me that this negotiation has happened behind closed doors and has already been discussed when the House Ways and Means Committee was in the process of drafting it in the first place. So at this point, it's been drafted and I guess published would be the right word, by the House Ways and Means Committee. It goes to the legislative floor at some point when the Speaker of the House brings it up, I guess. As you can say, I'm very naive when it comes to the procedures here in the legislative process. I don't know that much about it. I'm probably butchering the description. But at some point, it goes to the floor, they debate on it. And the fact that there's been adjustments to Biden's initial agenda in the initial draft of the bill tells me that it's likely, not unlikely, I should say, that there won't be that much negotiation when it gets to the House floor, because that's already happened behind the scenes. So with all this in mind, the draft that we're in possession of that's been published by the House Ways and Means Committee may be a little more representative of what the ultimate law will look like than other tax reform stuff that we've seen in the past. So for that reason, and because there are some timely things that I think we all ought to know about as investors and prudent financial decision makers and business owners, I want to bring it up on the podcast and discuss the implications of the bill in its current form, as opposed to waiting around until it becomes law, because there probably will be a few changes, even if they're minor. So with that, I've read some of this document. I haven't read all of it. I've read several summaries of the document that point out relevant issues for business owners, for investors, people that I trust. A lot of them I know and follow, and I think do a great job of summarizing these things, because I don't have any interest in reading the entire 800 or 1,000 pages or whatever the actual bill looks like. So I'm gathering this information from a bunch of different sources. And what I want to do in today's episode is communicate the relevant points as I see them to the podcast's listenership. So the first thing that jumps out at me, the thing I'm going to start with that is a surprise, was not part of Biden's agenda previously, but is in the bill, is the prohibition of Roth IRA conversions on after-tax contributions. This is a big deal because the backdoor Roth IRA conversion is a maneuver to get money into a Roth IRA, even if your income is too high to contribute to that account directly. This is a maneuver we've been using for a lot of years for a lot of our clients. It's very convenient. You make an after-tax contribution to a traditional IRA, you wait a little while, and then you convert it from a traditional to a Roth IRA. You can do the same thing within a qualified retirement plan, like a 401k. You make an after-tax a salary deferral through payroll. You convert it once the balances are in the plan to a Roth 401k account. Your plan has to allow it. If you own the business and can pull the strings in the plan, then it's a really nice feature to have in your retirement plan for you and for employees. Well, this bill takes away after-tax or conversions of after-tax contributions entirely.
So backdoor Roth IRA, backdoor Roth 401k conversions would be off the table entirely. Now, the timing of this is important. There's been a lot of speculation surrounding whether the tax changes, both changes in the brackets and thresholds and amounts and all that stuff we'll cover here in a few minutes, and other stuff, changes to capital gains, estate taxes, and so forth, whether it would become effective in the future, maybe January 1st of 2022, or retroactive to some point earlier this year, perhaps January 1st of 2021, which is somewhat uncommon, but did happen back in, I think it was 2010 when they put through the tax law changes in Obama's first term. So at any rate, hypothetically, this thing would become effective January 1st of 22, which means that if you're someone who has after-tax balances in an IRA or a 401k right now that you haven't converted, now is probably the time to consider converting them. If you have after-tax balances in a traditional IRA and no pre-tax balances in a traditional IRA, now is the time when you want to convert them. But let's say you have $10,000 in an IRA based on money that you've contributed and have paid tax on. That's an after-tax contribution. And maybe another $10,000 in an IRA that you haven't and deducted the contribution for. Your total balance across all your IRAs is $20,000. There's this pro rata rule that you should be aware of. If you converted $10,000 of your IRA balances to a Roth, you don't just get to choose the $10,000 that you've already paid tax on. You have to take a proportionate amount of all of it. And since you have $10,000 that you've paid tax on and $20,000 across all your IRAs, 50% of anything you convert to a Roth IRA would be taxable. That said, it may still make sense to shovel everything into the Roth IRA because starting January 1st of next year, you may not be able to convert any of the after-tax contributions. So it's something you should discuss with your tax advisors this year. Again, it's not relevant if you don't have any after-tax contributions sitting in those accounts. So if you've been doing backdoor Roth conversions each year, you've already done it for this year, or if you've been doing them every year and well, let me rephrase that. If you've already converted everything for the year, then you don't have to worry about it. If you've made your contribution for the year but haven't done the second step and converted it, you might want to accelerate the timeline there a little bit. Now, there are no changes immediately to the ability to do Roth conversions otherwise. So conversions of pre-tax dollars into Roth IRAs or Roth 401ks still allowed, with the caveat that 10 years down the road, starting in 2032, high-income earners may no longer do any form of Roth IRA conversions. That's defined as $450,000 of income for married people filing jointly, or $400,000 of income for single filers. So why do they make this effective 10 years from now? Why don't they just do it this year? It's because these Roth conversions generate a lot of tax revenue for the federal government. And putting a timeline on it gets people to do it sooner, but after the timeline is over, you can't do any of it if you're a high income earner as described by those definitions. So this is a big deal. Backdoor Roth conversions going away entirely for everybody starting January 1. 10 years from now, if you're making over $450,000 as a married couple, you can't do any conversions at all, even of your pre-tax dollars. That's important. Now, on top of that, you can see here, if you're watching the video, you can see my notes. If you're listening, you can't. Your ability to put money into an IRA changes. Currently, it doesn't matter how much money you make or whether you already have a qualified retirement plan you can contribute to at work. You can always, as long as you have $6,000 or as long as you have some earned income, you can always put the lower of that amount of income or $6,000 into a traditional IRA, $7,000 if you're over the age of 50. The question is whether or not you can deduct those contributions. So you can make $1 million a year and still put money into an IRA, but you can't deduct the contributions, which is why we do that backdoor conversion. That said, starting next year, high income earners may no longer make after-tax contributions either. So that mark, again, $450,000 for married couples, $400,000 for single couples. No, excuse me, I got this wrong. I misread my notes. If you have really large balances across your retirement accounts and you're a high income earner, then you may not make IRA contributions. So strike what I just said. This is new to me too. It's only a couple of days old. You have to forgive me. So the limits here are you total up all the values across all your retirement accounts, IRAs, 401ks, SEP, simple IRAs, all that stuff. If it totals more than $10 million and you're over those income limits of $450,000 for a married couple, $400,000 as a single filer, then you cannot put any more money into an IRA. It doesn't impact 401k contributions, SEP IRA contributions, or simple IRA contributions. That's interesting. But you can't use traditional IRAs, and you certainly can't use Roth IRAs because your income would be way, way over those thresholds. So that's another pretty big change. For a lot of our high income earners, even though they can't deduct contributions to the traditional IRA, it still makes a lot of sense to park the money there every year because the growth is still tax deferred until you pull the funds from the account later on. Then, so I mentioned that $10 million threshold for size of retirement accounts. Not only if you're a high income earner and have an account of that size are you no longer able to put more money into an IRA, you have aggressive mandatory distributions anytime the total value across all your retirement accounts exceeds $10 million. So let's say you have an IRA, a Roth IRA, a 401k, a cash balance plan, whatever. You add up the total value across all those accounts, and if it exceeds 10 million, starting next year, you have to start taking money out of it, even if you're younger than 59 and a half. So let's say you're 50 years old, you've got $15 million across all your retirement accounts. It's a healthy chunk of change to have in these tax-deferred vehicles. But any amount over 10 million, between 10 and $20 million of account value has to be, 50% of it has to be distributed that year. It's a big deal. If you're younger than 59 and a half, you do not pay a 10% penalty on it, but you still have to take it out, and it's counted as taxable income, which is a big bummer. 100% of account balances over $20 million must be distributed. This is a pretty substantial change here, and it's in direct response to something that Peter Thiel did a few years ago, and this has been in the news in the last few months. Peter Thiel is a Silicon Valley investor, tech person, really well regarded. He was an early investor in Facebook. I think he may have been one of the PayPal founders, if I recall. He is currently the CEO of Palantir, which is a high-flying tech company. At any rate, Peter Thiel made a very early investment in Facebook and this is before Facebook was a public company, and he put that investment in his Roth IRA. Now that investment is worth $1 billion, and it's in his Roth IRA. So he has a Roth IRA of $1 billion that's all tax-free. And I have no doubt that this portion of the potential tax legislation here is in direct response to the $1 billion sitting in tax-free money in Peter Thiel's Roth. So if this is passed, he has to take that out next year. He doesn't get taxed on it because it's a Roth. Nonetheless, it's a substantial change. Okay, now, so those are the major changes for retirement accounts. No more backdoor conversions. No more conversions at all starting in 2032 for high income people. No more IRA contributions if you have a large size, a large amount of retirement assets and you're a high income earner, and aggressive mandatory distributions from your retirement accounts if you have more than 10 million across those retirement accounts. Doesn't incorporate anything to do with your taxable accounts in your name, jointly with your spouse and your trust. That has nothing to do with it.
So the issue that most people have been probably following the closest as this discussion of how tax laws will change as materialize and evolve, the thing that most people have been following, I would say, is the adjustment to the tax brackets and the tax rates themselves. So prior to the Tax Cut and Jobs Act of 2018, the top tax bracket was 39.6%. If you're a high income earner, then you pay potentially an extra 0.9% Medicare surcharge on there, potentially 3.8% net investment and income tax on investments, capital gains, that kind of thing. That went down to the top tax bracket went down from 39.6 to 37% as a result of the Tax Cut and Jobs Act. So this pending legislation, the American, what is it called? The American Families Tax Reform Plan, I think, or Act. I can't remember. But the way that it's written in the bill brings the top tax rate back up from 37 to 39.6%, but it also changes the thresholds at which those tax brackets apply. So everything that Biden's been talking about in terms of if you make less than $400,000 a year, you're not going to pay any more in tax. That's all seems to be accurate from what I have learned so far. If you're over those amounts, it's a different story. So currently, with the top tax bracket being 37%, if you're married and filing jointly, that tax bracket kicks in at $628,300 of taxable income. If you're single, it's $523,600. With the adjustments, not only does the top rate go up to from 37 to 39.6% again, but it kicks in at $450,000 for married people filing jointly, $400,000 for single filers. So this threshold, notice the pattern here. This threshold of when do the higher tax rates kick in is consistent for all these different adjustments. $450,000 for married people filing jointly, $400,000 for single filers. So it's a big difference. If you're under those thresholds, 450 and 400, you're not going to see a difference in 2022. But the timing on this one is, as we kind of all hoped, wouldn't be effective until January 1 of 22, as opposed to being retroactive to January 1 or sometime in the middle of this year. So plan accordingly. This will result in more tax for high income earners. It means that if you have potential deductions and you have the choice of when you might want to claim them, this year or next year, it's logical that you might want to kick them into next year and save them for 22, as opposed to using them this year when they might not have as large a benefit to you. Now, the capital gains rates are the other side of this. So currently, we have 3 different levels of capital gain, well, really 4, but 3 primary levels of long-term capital gains. So if you have an investment that you've held for less than 1 year, let's say you put $100,000 into Facebook stock, you sell it 3 weeks later at $150,000, you have $50,000 of taxable capital gain. That's taxed at your ordinary income tax rate because it's a short-term capital gain. You held it for less than 1 year. The moment you hang on to that thing for 366 days, it becomes a long-term capital gain. Currently, long-term capital gains are taxed at 0% at the federal level if your income is between $0 and $80,800 for a married couple, or under $40,400 as a single filer. Remember, we've got 3 levels. So that capital gain, you can't make $75,000 and then have a $50,000 capital gain and have that gain taxed at 0%. The 50,000 of gain counts toward your income. But it's still a nice harvesting opportunity for a lot of people, particularly after they retire and shut off their income. Currently, the 15% bracket, which is the next one up, again, starts at $80,800 for married people, $40,400 for single filers. You're going to pay 15% on gains when your income is between those thresholds and $501,600 and $1,600 for married filers, $445,850 for single filers. So the vast majority of people who are paying tax on capital gains these days are under those levels of taxable income. So for most people across the country, right now you're paying 15% on your capital gains. And if you're a high earner above, 250,000 or 200,000, married filing jointly versus single, you pay that additional 3.8% net investment and income surtax on top of the 15%. If you're over those thresholds, that's when the top tax rate kicks in at 20%. So again, if you're married, 0% up to $80,800 of income, 15% between there and 501,600. Anything above that is taxed at 20%. Again, plus the 3.8%. The reform plan would go back to these thresholds of 450,000 for married people, 400,000 for single filers. And if your income is above those thresholds, the top rate goes from 20% to 25%. So what this means is that, again, it increases the top tax bracket, the rate of tax you pay for high income people, and it lowers the threshold at which that top tax bracket applies. So plan accordingly. Now, this one you might say, well, I've got all this, Facebook stock in my taxable account. I better run out there and sell it and realize this gain this year, so I'm not paying the 25%. I'm only paying 20%. Reasonable thing to think about. This is the one area that I've come across so far that is retroactive to a prior date. The income tax changes, the Roth conversion stuff, everything else appears to be written to become effective January 1 of 2022. The change in the capital gains taxes, as it's currently written, is retroactive to September 14th when this thing was published. So if you had a binding agreement in place to sell something, but it hadn't closed yet, if it's an agreement you can't back out on, and you have it in writing and all that, then that qualifies for the old rates. Anything else, if you run down and sell that Facebook stock today, that's going the new rates and the new brackets are going to apply. So this is the one area that's retroactive that I've come across so far. There might be others in the bill, but so far this is the only one. So we've got the top tax brackets going up, the thresholds at which they apply going down. Capital gains tax, same deal. Top rate goes up, threshold at which they apply goes down. And for really high income people, above $5 million in income, there's an additional 3% surtax on anything above $5 million in income. And the wrinkle in this one is one way that tax planners will often manage tax payments or tax liabilities for people who might be in that bracket is if you're making that much money, you probably have a lot of stuff you can do as far as deductions you can claim to bring you back to lower thresholds and avoid that surtax. Maybe if you're sitting at $5.5 million of income, that last $500,000 is going to incur an extra 3% tax. Maybe there's $500,000 of deductions you can find somewhere because you're making that much income. You have a lot of stuff that you can do. This 3% tax is a surtax that's not influenced by any of those itemized deductions that we might otherwise come up with. So if this is you, if you're making more than $5 million a year, I would think that the opportunities for avoiding this layer of tax would be to claim deductions at the business level, at the entity level, so that they don't flow through to your personal 1040 in the first place. I'm just kind of spitballing here. This is really new, but that's the most logical thing I can think of off the bat. That $5 million threshold, the same for married people and single filers. The other interesting wrinkle here, if you look at all the tax returns across the United States, the number of them that are reporting income over $5 million is really low. There are not that many people across the country making more than $5 million a year. So you would think that, this is maybe to raise a little revenue, but it's not going to impact that many people. Well, the surtax applies at income levels for trusts at much lower thresholds. So if there's an irrevocable trust, not a living trust that you might have your household bank accounts in your house and that kind of stuff that you pay taxes on. If you have a trust that pays its own taxes, has its own tax ID, you're not responsible for gains and losses in. The additional 3% surtax comes into play if that trust has more than $100,000 of income, which means that it has to be a pretty substantial size to produce enough income to get there. But again, with dividends, capital gains, a lot of ways that trusts can make money, that's not out of the realm of possibility for a lot of different trusts. Now, there are some nuances here. Why don't you split it into two trusts instead of one? Maybe there's some prohibition that looks at that. I don't know where the boundaries are. But suffice it to say that we should be aware of this when doing estate planning and thinking about placing assets in trust for the benefit of future generations. That 3% surtax will apply at a far lower threshold. Now, on to stuff for businesses. So we'll talk about the estate tax here in just a minute. I've got a couple more points before we get there. One of them is with regard to businesses. And two things that I've talked about on the podcast in the past for business owners is, number one, if you own a C corporation, the C corporation by definition pays its own tax. So you've got revenue. If you're looking at your income statement, you have revenue at the top, you have all these expenses, and you have profits left over at the bottom. So if you have profits left over at the bottom, the corporation pays tax on those at the corporate level. If you take the cash and distribute it back to yourself in the form of a dividend, you as the individual get taxed on that dividend too. It's two forms of taxation. So the maneuver there is a lot of corporations, a lot of people running corporations, smaller corporations, I should say, like to adjust their reinvestment back into the company or their personal W-2 compensation so that they don't have any of those distributions left over to be double taxed. So the corporate tax rate, currently it's a flat 21% that a C corporation pays on those earnings. That goes up to, I don't have this in my notes, it's either 26.5 or 28.5. I want to say it's 26.5%. I should have looked that up, but I don't have it in my notes. The more relevant point here is how profits on pass-through business entities are taxed. So the C Corp pays taxes at the organization level. An S Corporation, or an LLC, or a partnership, or a sole proprietorship, basically anything other than a C Corporation, passes through profits left over at the end of the year pro rata to its owners. So if you have an S Corporation, just like the C Corporation, you've got revenue, you've got expenses, you've got profit left over. Well, the corporation itself doesn't pay tax on those profits. If there's $50,000 left over at the end of the year and there are two 50-50 owners, then those owners on their personal taxes have to report $25,000 of profit distributions from the corporation via what's called Schedule K1, whether they like it or not. And there's a lot of planning and maneuvers between how much do you take out of the business as W-2 income paid to yourself, how much do you let fall to the bottom line as profits. The convenient thing there is that currently, any profits you allow to fall to the bottom line. So if you're paying yourself $100,000, you have $25,000 left over. The $100,000 you're paying yourself is subject to Social Security and payroll taxes. The $25,000 at the bottom, you don't, nor do you pay the 3.8% net investment income tax, which applies to people over that $250,000 threshold for married, $200,000 for single filers. So it's been really tax advantageous in the past to, what's the right word here? Plan thoughtfully and not take too much out of the business through W-2 wages. You can't take everything out as profit distributions because the IRS forces you basically to take a reasonable amount out as W-2 wages commensurate to your efforts in the business. But there's planning opportunity there to pay less in tax. With the reform, that $25,000 of distributions would be subject to the 3.8% net investment and income tax. So that's a change. And if you couple that with the adjustments in the tax brackets in the first place, somebody in the highest tax bracket, formerly they might have been paying 37% on those distributions because that was the top tax rate. Now they might be paying 39.6% plus the 3.8% net investment income surtax. So the calculus here changes quite a bit, and it's not quite as advantageous to owners of pass-through securities. I could go on and on about that for another half an hour, but I'll curb that for the time being. The other change from a business owner standpoint has to do with qualified business income deductions. So this is the 20% deduction that owners of those pass-through securities get. So if you have that, I'll round the numbers off to make it a little bit easier. Let's say in that S corporation, you have $100,000 of profits in the year. Part of the Tax Cut and Jobs Act of 2018 was the Republicans wanted to simplify, doing air quotes for those of you listening and not watching, simplify the tax code. And so they got rid of a bunch of business deductions and replaced them with, hey, we're going to trade you these deductions. You can't take these deductions anymore. We're going to replace it with one fat across the board 20% deduction on all your business profits. Of that 20% deduction, so if you're making $100,000 in profits, now you're only taxed on $80,000 of it. If you're in that position, you have to designate whether your business is a specialized service and trade business or not. If it is, if you're in legal, accounting, medical, financial planning, my business is subject to this. If you're in a service or trade business, that 20% deduction starts going away and phases out at higher levels of income. If you're not, it has another test that could limit the amount that you can deduct. The change here is that there's going to be a hard limitation on the size of that qualified business income. And effectively, if you're a specialized service or trade business, if you're in law, accounting, medicine, financial planning, I think engineering does not count if I recall, but for the most part, it's not going to affect you at all. Because if you are a specialized service and trade business, your QBI deduction is going to phase out before this comes into play. If you're not, if you're in construction, manufacturing, any other industry, the max QBI deduction you can claim is $500,000 for joint filers or $400,000 for single. Trusts and estates can still claim the deduction as well, but the limit's only $10,000. So again, no cap on income here, but there's a cap on the deduction. And so if you've been claiming a really nice, large, qualified business income deduction over the last couple of years, this is an area where you want to talk to your accountant soon to plan for what the ramifications might be going down the road. Again, if you're in law, medicine, accounting, any specialized service business, it doesn't matter. You don't need to rush to do anything because it's not going to impact you. The change won't. If you're in manufacturing, construction, something to those ends, it absolutely will. If you're claiming a very large deduction right now. Now, two other items. I don't exactly know where we're at on time so far, but I hope I haven't bored everybody to death yet. Two items that I want to cover. One has to do with cryptocurrency assets. Securities, stocks, and bonds, other stuff that we buy through the capital markets, have this thing called the wash sale rule. And what that means is that in order to claim the loss for tax purposes on an investment in a security, you have to be out of the position for at least 30 days. So if you buy Amazon shares and you put $10,000 into it, Amazon gets cut in half. Now your shares are worth $5,000. You might think, well, why don't I just sell those shares, bank that loss, put that $5,000 loss aside to net against future gains or future income or some combination of the two. But I think Amazon's going to rebound. I don't want to exit the position. Why don't I just sell the shares and then buy them back like 2 seconds later? Because that way I can claim the loss. Well, you can't do that with securities. There's this wash sale rule. You have to be out of Amazon. You can't have any beneficial position in it for 30 days. At that point, once the window is over, you can buy it back and you have that $5,000 of loss to claim against future gains. You can use up to $3,000 a year against your income. There's a lot of tax benefits to that. So there's a lot of strategy in planning around that when we're managing our portfolios. But the wrinkle is that cryptocurrencies currently are not eligible, let me rephrase that. The wash sale rule does not currently apply to cryptocurrencies. So if you're trading Bitcoins, Ethereum, all these other volatile assets out there, if you're doing them thoughtfully, you can wriggle your way out of substantial taxable capital gains by harvesting losses thoughtfully, because you don't need to, if one of your coins falls and now you have a 25% loss, you can claim that loss, sell it, buy it back real quick without running afoul of the wash sale rule because it didn't apply to cryptocurrencies in the first place. Now it might if this bill is passed. So that changes the landscape and tax planning strategy for anybody operating in this crypto game, I would think. You've also got the same applying to commodities. So if you're trading gold, silver, that kind of thing, wash sale rule doesn't apply currently. The reform bill would make it applicable to not just crypto, but also commodities and a couple other things that are not currently classified as securities. What's more than that is the wash sale rule would have an extension to immediate family members too. So if you don't have a position, but your spouse does, that would count. So there are some technicalities here. If this thing does get passed and if this crypto area is included in the final bill in the law, something that we need to incorporate and be aware of if you're trading that kind of stuff. NFTs, same thing. Now, last thing I wanted to touch on, estate planning. So currently we have an estate tax at the federal level. If you die and there's more than $10 million plus inflation adjustments in your estate, right now it's, $13, $14 million, then anything above those amounts is going to have to pay the estate tax. And this is when we get into really ornate estate planning with the use of trusts, all sorts of different trusts, because if you have an estate that's worth $100 million, the vast majority of it is going to be subject to the estate tax. So if you're a tech entrepreneur and you have $100 million estate, $100 million estate, and you're 45, well, you've got a long way to go until you kick the bucket, my friend. If you live until you're 85 or 90, that $100 million estate could be worth a lot more down the road. So one of the maneuvers that estate planners like to use is you park some of that estate in a trust, pay estate or gift tax on those assets now before they grow further, and you're locking in the tax that pool of assets will pay today before it grows to become a much larger pool. And currently, like I said, it doesn't apply if your estate's worth less than $10 million plus inflation adjustments, making it currently like 13, 14 million. That level of 10 million was established in the Tax Cut and Jobs Act of 2017. I think I said 2018 earlier. It was effective January 1 of 2018. It was passed late 17. So the name on the bill is actually 17. But at any rate, prior to that, the lifetime gift tax exemption and unified estate credit was $5 million. The Tax Cut and Jobs Act doubled it to 10, but it was set to sunset and revert back to 5 million starting in 2026. The bill makes that reversion back to 5 million plus inflation adjustments effective January 1 of 2022. So this is relevant. This is really relevant. If you have an estate worth between $5 and $10 million now, you may want to think about doing some estate planning before the end of the year to get some of the assets in trust, take advantage of the lifetime exemptions and current thresholds before they get cut in half next year. Some people don't care about that. They want their stuff to go to the right people, and if on their death they pay some estate taxes along the way, that's not the end of the world. And if that's you, that's great. But if the intention is to minimize the amount that's being forked over to the federal government and potentially state governments here too, then this might be a pretty sensitive area of planning between now and the end of the year. The other state issue that was thrown around a lot, and this may still be added, was speculation that the step up in basis at death might go away. So if you have $1 million in an investment account, let's say 30 years ago, you bought a bunch of stocks for $100,000 at the time. Now, when you're older, that $100,000 in stock is now worth $1 million. If you sold it, you'd have to pay capital gains tax on $900,000. If you'd have done that prior to September 14th, then maybe you could have done it at the old rates. But point being, currently, if you die and bequeath those assets to beneficiaries, your beneficiaries receive the assets and they get a step up in basis to $1 million. Meaning if they sell the assets, they're not paying any tax on those gains. If you sell them, you're paying tax on that $900,000 difference. So again, for you people out there listening and not watching, what I'm doing is this thing with my hands. You've got a $100,000 basis down here. Here's what you paid for the shares. They're now worth $1 million. That's your amount that's subject to capital gains taxes. Once you die, that basis steps up to the value of the assets on your day of death. That's a big benefit from an estate planning standpoint for a lot of people. There was a lot of speculation that would go away entirely, or maybe there would be like a $1 million exemption. Anything above that, you do not get that step up in basis on. That is not in the bill. And that's very interesting. So again, it may be added when this goes to the floor and gets tossed around and negotiated on. Currently, it's not in there. So that estate planning maneuver could remain, which would be beneficial to a lot of people. But we'll see. So that's what I've got for today. This, if you're still listening to me drone on about taxes, this stuff probably affects you, or you're halfway interested in it. I haven't bored you to death yet, but suffice it to say, tax rates are going to go up for high income earners. Capital gains rates are going to go up. Estate tax thresholds are going to go down. The way businesses are taxed is going to change by a little bit. Roth IRA conversions are going to change by a lot. A lot of our clients are doing a lot of Roth IRA conversions because it's such a powerful strategy. And for clients of ours out there who are listening to this, there are not that many of you to where Roth IRA conversions after you stop working are going to be impacted. The backdoor Roth IRA conversions that we're doing while you're in your earnings years, unfortunately, looks like those are going to go away. But the age-old strategy of you're working, your income's up here, you stop working maybe in your 60s before you have mandatory distributions and Social Security kick in at 70. So that's that period between when you stop working and when Social Security mandatory distributions kick in, you do aggressive Roth contributions or Roth conversions then because your income's low. That strategy is really not going to change because the benefit, because you're going to be in those low brackets to where the opportunity for Roth conversions is not going to phase out. So at any rate, there's my quick and dirty, not so quick, but really dirty probably. Again, I'm summarizing stuff I've seen and read that have been written by people a lot smarter than me, but I really trust. The ultimate law and rules could be different, maybe substantially different than what we covered today, but the fact that a lot of changes have already been made, the fact that the bill in its current form is different than what's been communicated tells me that a fair amount of those negotiations have probably already taken place. So if I were a betting man, I'd say that a lot of the stuff is probably going to be in there and we're probably going to see a new law by the end of the year. So I'll leave you with that. Thanks for listening. Hope everybody had a great week.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.